Hello everyone, and welcome back to Dr. Tao's Quant Lab. So far in Chapter 2, we have built the trend engine. We know how to ride the highway using Keltner channels, and we know how to spot a breakout using Bollinger bands. But all of those trend indicators share one critical flaw. They lag behind live price action. If we want to time the exact moment a stock is going to reverse, we cannot just look at the trend. We need to look under the hood. We need to measure internal momentum. Today, we begin our study of oscillators, starting with the fundamental momentum indicator, the relative strength index, or RSI. The RSI does not measure absolute price. Instead, it measures the internal tug of war between buyers and sellers. Mathematically, it looks back over a specific number of periods. It isolates all the positive days to find the average gain and divides that by the average loss of the negative days. Because of the way this fraction is normalized, the RSI is mathematically trapped in a box between 0 and 100. Think about the extremes. If a stock closes green every single day in our window, the average loss is 0. The math pushes the RSI to exactly 100. If it closes red every single day, the average gain is 0, and the RSI is exactly 0. But because complete relevance streaks are statistically rare in a two-way auction market, a normal, healthy stock will oscillate smoothly in the safe zone between 20 and 80. When you log the RSI on your professional trading terminal, you will usually see these three lines: a 66-day, a 12-day, and a 24-day line. In the quant lab, when we are timing an entry, we ignore the 12 and the 24. We focus almost exclusively on the 6-period fast line. Why? Because oscillators are designed for immediate timing. The 24-day line carries too much historical data. It smooths out the math so much that it lags. By the time a 22-day RSI tells you a stock is exhausted, the reversal has already happened. The 6-day line cuts out that noise and gives us raw, immediate momentum. If you read a classical training textbook, it will tell you that an RSI over 70 is overbought and under 30 is oversold. Throw that rule away. In modern algorithmic markets, a strong tech stock can stay pinned at 70 for weeks. And if you short it, you will get crushed. We utilize stricter mathematical extremes, 80 and 20. If the fast RSI breaches 80, the internal buying power is mathematically exhausted relative to how fast the price is moving. Do not chase the rally. But listen carefully. Hitting 80 is not a blind trigger to short sell. Extreme momentum can sustain an 80 reading. You must wait for structural confirmation on the chart between betting against it. Conversely, if the RSI plugs below 20, the selling pressure has far outpaced the stock's natural descent. The sellers are out of ammo. Do not panic sell here, but again, do not blindly bottom fish until the chart confirms the turn. Okay, now let's look at a trading app. To find the RSI, you go to indicators and use this, click this RSI, and you can see it appears at the bottom of your K lines. And here are the values. So here we have 80 and 20. So we need to focus on the moment that it's above 80 or below 20. The settings is perfect here because if you look at that, the move average cycles, we have 6, 12, and 24, which is perfect. And we don't need to do anything in general. And this is the K-line for NVIDIA. Now, let me show you the single most predictive signal the RSI can generate, divergence. Divergence happens when the trajectory of the price action mathematically contradicts the momentum. Right here. Look at this bearish divergence on Nvidia from April 2026. On April 20th, the stock pushed higher. And the RSI spiked to massive extremes of 89 point. So look at this orange value here of 89.3, which you can see in the first blue box right here. But look at what happened next. On April 27th, the stock price pushes to a brand new higher high. Okay, from here to here, to 15. Retail traders buy the breakout. But look down at the RSI in the second blue box. It peaked lower at 85.9. Price made a higher high, but momentum made a lower high. The engine was dying. That divergence triggered a sharp downward correction. Okay, now look at the exact opposite. Bullish divergence. This is Tesla in March 2026. On March 20th, the stock flashes down, pushing the RSI to 20.7 in the first blue box. Then on March 30th, the stock crashes to a terrifying new lower low. Okay, from here to here. Okay, from here to here. Okay. Weak hands panic and sell, but look at the RSI in the second blue box. It printed a higher low of 23.1. Selling pressure had secretly evaporated, and the stock immediately ripped higher from here to here. And let's get back to the lecture. Again, I have a screenshot of everything in the lecture notes for your reference. So, how do we know when an active divergence is finally over? It resolves in one of two ways. The first way is the cross. The price finally reverses, putting that highly reactive 6-period fast line across the slower 12-day and 20-day lines. The structural cross proves the momentum has shifted, releasing the tension so a new cycle can begin, like our examples. Okay, so we have after that, we have a cross like this, and also like this, there is another cross after this divergence. But the second way is the reset. Sometimes a massive news catalyst hits the market. The stock continues to trend with such overwhelming force that the RSI is dropped all the way up to make a brand new absolute high, matching the price chart. When that happens, the divergence is naturally eliminated, and the massive trend simply continues. Because divergence can reset, it is a warning light, not a blind trigger. Always wait for structural confirmation, which we will talk that in the next chapter. That's all for today. See you in the Quant Lab.